Hello friends, welcome back to another session of Get Set Go series. Hope that the videos have been helpful to you. If so, please do like and comment. If you have not yet subscribed to the channel, please do subscribe so that you get continued notification of all the upcoming videos. Today we are going to be learning about dissolution of a partnership firm. Now, what is dissolution of partnership firm? It means dissolution of partnership among all the partners of the firm. Now, we have learned about admission of partner, the death or retirement of partner. There is dissolution of partnership amongst the partners, but it continues with the remaining continuing partner who continue the business with a new agreement. But here, what we're talking about is dissolution of partnership firm. The entire firm is being dissolved. Therefore, here what happens is the firm itself is closed down. The business is completely closed down. The economic relationship that whatever is there between the partners, that completely comes to an end. So among all the partners, whatever was the economic relationship of what they were contributing as capital, sharing profits and all, entire thing comes to an end. So thereafter, they are no longer going to be partners in the firm. What is going to happen is that all the assets of the firm are going to be sold, or amount is going to be realized from the sale. All the liabilities of the firm would be paid off, and after that, if any balance is left, after the assets have been sold and realized and liabilities are paid, if balance is still left, that would be paid to the partners. Now, there can be another situation where after paying off all the liabilities, still money might be required, where you find that the amount that you've realized from asset is lesser than the liabilities which are required to be paid. And further, still more liabilities are required to be paid. For that, whatever is the deficiency which is there, that we can call as deficit, that would be brought in by the partners. They might be even required to sell off their personal assets. That doesn't matter. They will have to bring in the deficit amount so that the liabilities of the firm that is being closed down here would be paid off. And when we are talking about dissolution of partnership firm, we would be talking about realization account. This is the account that is prepared wherein we will transfer all the book value of the assets except cash and fictitious asset. We would transfer all of them to the debit side of realization account. We would transfer all the outside liabilities to the credit side of realization account at book. And then we would pass the respective entries that we'll be learning in today's session. We should go through the realization account. Thereafter, we would be closing out the realization account, and the result of that would be realization profit or loss on realization. So this profit or loss on preparation of realization account shall be transferred to the partner's capital account in their profit sharing ratio. So whatever is the agreed ratio, in that ratio, the profit or loss on realization shall be transferred. So this is in short about the theory part of the dissolution of partnership firm. Now let us go and learn how to pass the journal entries when there is a dissolution of a partnership firm. So the first question that we are going to take is Ankit, Bobby and Karthik were partners in a firm sharing profits in the ratio 4:3:3. So there are three partners, Ankit, Bobby and Karthik. The firm was dissolved on 31st March of 2018. Pass the necessary journal entries for following transactions after various assets other than cash and bank and third-party liabilities have been transferred to realization account. First adjustment that we are going to learn related to this dissolution is the firm had a stock of 80,000 rupees. Ankit took over 50% of the stock at a discount of 20%, while the remaining stock was sold at a profit of 30% on cost. So the total stock of the firm is 80,000. We will now learn how to pass journal entry for this particular transaction. What is the value of the stock which was owned by the firm? Rupees 80,000. They have said Ankit took over 50% of the stock. So Ankit is a partner. He has taken over 50% of rupees 80,000. That is 40,000 worth. But has it taken it over at 40,000? No. It's taken it over at a discount of 20%. So we would subtract the amount of discount at the rate of 20%. Find 20% of 40,000. 20 ones are, 25s are, 5 ones are, 5 eights are, so 8,000. So 32,000 is the agreed value. We call it as the agreed value. At this value, Ankit is taking over the stock. So when any particular asset is taken over by a partner, we debit the partner's capital. Whenever anything is given to a partner, we credit the capital account of that partner. But when an asset is taken over, he's taking over an asset. So we will be debiting the partner's capital. So journal entry for this would be Ankit's capital account debit. Now here, the agreed value would be the value which would be debited. And the other account to be credited is realization account. Why? Because here all the assets have been, all the various assets other than cash and bank have been transferred to realization account. So we have to credit the realization account for this one. So this is for stock taken over by Ankit. So first part then. Now still there is only 50% stock was taken over by Ankit. What about the rest? Said while the remaining stock, that is the balance, which is 50% of 80,000, that is 40,000. For this, they have said they were able to sell it off. It was sold off at a profit of 30% on cost. This is the cost. Now we add the profit, which is at the rate of 30%. So calculate 30% of 40,000. 0 cancelled here. So 3 into 4,000, 12,000. So they were able to sell it at 52,000. So sale value of the remaining stock is rupees 52,000. For this, what is happening? It has been sold. So what happens? Your money is going to be realized. So we would debit cash or bank account debit. 52,000. 2. Again, we are going to be crediting realization account. I have already told you the logic, because all the assets have been transferred to realization account. So there is no stock account. Now there is only realization account from where we are going to credit and close down. So this is for remaining stock sold at 30%. So this is the journal entry that you would be passing for this particular transaction. Now moving to the next, related to the same firm. A liability under a suit for damages included in creditors was settled at 32,000 as against only 13,000 provided in the books. So from this, what we understand is that there was a liability under a suit for damages. There was a case filed against the company for some damages and the liability was there, and that was included in the creditors and was settled at 32,000. But being a liability, we would have provided for it because we didn't know the exact amount. We have provided it. So how much has been provided? As against only 13,000 provided in the books. So in the books, creditors include 13,000, which is a provision for this particular suit for damages. But although we provided 13, actual liability came to 32,000. So 32,000 would be an outflow. Cash or bank would get reduced by that much amount, 32,000. So we can write this entry for payment. There is going to be an outflow here of rupees 32,000. But they have given total creditors of the firm as 50,000. So if the total creditors is rupees 50,000, out of that what is related to suit for damages which was provided in the books? It was 13,000. So therefore balance creditors would be how much? 37,000. Now, there's a very important concept that if nothing is specified, still you should ensure that the liabilities which are there, outside liabilities, you have to ensure that they are paid off. So here, nothing has been specified, only about the 13,000 part which is provided. They have said it got settled at 32,000. What about this 37,000 worth of creditors? That we have to ensure that they are paid. Therefore, total payment which you are going to show is for the suit. You are going to pay rupees 32,000 as against the provision of 32,000. And for the balance creditors, we will take the 37,000 worth. They have paid 37,000. So totally 69,000 should be the amount of creditors that is paid. Now, when we pass a journal entry, creditors have been transferred to the credit side of realization account at book value. Now, we have to show the payment. So, when we show the payment, we would debit the realization account with 69,000 and credit the cash or the bank account. Because we don't know the exact mode, whether it was paid in cash or by check, we are using this term. So, this is for the creditors paid off. This is the journal entry that we would pass. Now going to the next adjustment. Said Bobby's sister's loan of 20,000. So Bobby is a partner. His sister had given a loan. This is an outside liability. It is not a partner loan. It is partner's sister who has given loan. So this is an outside liability. That was paid off 20,000 along with interest of 2,000. So total how much payment was made? 20,000 plus 2,000, 22,000. So we would debit the realization account. Why are we debiting realization account? Because that entire loan and the interest have been credited. Being an outside liability, it has been credited to realization account. Therefore, we have to ensure that entire amount of the loan and the interest is paid off. So we debit realization account and credit cash or bank account to show the settlement by means of payment. This is for Bobby's sister loan paid off along with interest. So I hope that was clear. Moving further, let us go to this one more transaction that we have here. He said Karthik's loan of 12,000 was settled at 12,500. Now, who is Karthik? Karthik was the partner, third partner. Ankit, Bobby, Karthik. So, Karthik's loan means is a partner's loan. He is a partner's loan was 12,000. It was settled for 12,500. Now, partner's loan would normally be paid off. So, we would debit Karthik's loan account. But in the books, Karthik's loan account would be 12,000. But they have said it has been settled for 12,500. Means the payment which was made, cash or bank account, is 12,500. So what is this extra 500? The extra payment which is made would be debited to realization account. So this is the transaction to show the partner's loan paid off. So I hope it is clear how we solve this question in past journal entries in case of dissolution of this particular firm. Moving further, we'll do one more question. Here, the partners are Ravi, Shankar and Madhur. They were partners in firm sharing profits in ratio 7:2:1. On 31st March 2018, the firm is dissolved and after transferring sundry assets other than cash in hand and cash in bank and third-party liabilities in the realization account, the following transaction took place. So they have already transferred sundry assets other than cash and bank and all the outside liabilities to realization account. After that, they've given us this transaction. What are we supposed to do? Pass the necessary journal entries for the above transaction in the books of Ravi, Shankar and Madhu. First transaction they have given is creditors amounting to 5,000 were paid 3,500 in full settlement of their claim, and balance creditors were handed over stock of 90,000 in full settlement of their claim of 95,000. For this, now first thing, creditors amounting 5,000 were paid 3,500 in full settlement of the claim. So first part we will take this. So creditors have been paid off in full settlement 3,500. So what are we supposed to do? We would have already transferred this creditors to credit side of realization. So we debit the realization account. What was the amount which was paid? We have credited the realization account with the book value. So 5,000 would be there on the credit side. But it is being settled for 3,500. So we have to write 3,500 and show the settlement by crediting cash or bank account. So on the debit side of realization account, you have 3,500. So net effect of the settlement being made at lesser amount is all automatically coming into the realization account. So this is for the creditors being paid off in full settlement of the claim, a lower amount. Now they are further given a balance creditors were handed over stock of 19,000 in full settlement of the claim of 95. Very important point. When any asset of the firm is given to settle the creditors in full settlement of the claim, very important point, there would be no entry. Why? Because creditors at book value would have been credited to realization account, and this stock of 90,000 is there on the debit side of realization account at book value. So automatically the net effect of 5,000 will be coming to the credit of realization account. So that is why when any point of time you find that if they give you the transaction that creditors were handed over some asset in full settlement of the claim creditors, you have to remember you are not supposed to pass any entry for that. There will be no entry. Going to the next. Given debtors amounting to 1,40,000 were handed over to debt collection agency which charge 5% commission. So out of the debtors, 1,40,000 were debt. What they did, they didn't want to collect it themselves. They gave it to a debt collection agency. They would collect and make the payment. So for that service, they are charging 5% commission. So net amount that would be received by the business would be from 1,40,000. You have to remove the commission and balance would be received. Further, the remaining debtors was 47,000, out of which debtors of 17,000 could not be recovered because the same became insolvent. So after this, balance debtors which were left were 47,000. But out of that 47,000, it is now known that 17,000 cannot be recovered. Why? Because that much debtors have become insolvent, so you're not going to receive. So out of this particular thing, 47 minus 17, 30,000 only you're going to recover. So now, to pass journal entry, we'll first make the calculation. First, in respect of these debtors that were handed over to the debt collection agency was rupees 1,40,000 less commission which was supposed to be paid, which is 5% of 1,40,000. So if you see, it would come to 7,000. So the amount that would be received from the debt collection agency, we'll take it as A, is 1,30,000. Second part is for the remaining debtors. So what is the value of remaining debtors? Is 47,000. Out of this, bad debts, because they become insolvent, you're not going to be able to collect 17,000. So what is going to be received from the remaining debtors? 30,000. Let us take it as B. Therefore, amount received related to debtors would be A plus B. Is 1,33,000 plus 30. That comes to 1,63,000. This 1,60,000 is being received, so we debit cash or bank account debit. 2. All these debtors are being credited to the realization account. So right, debtors have been debited to realization account. So we put the realization amount on the opposite, that is a credit side. We'll pass the entry for 1,63,000. This is being amount realized from debtors or on account of debtors. Hope the calculation is clear. Moving on, next one is a bill receivable of 2,000 was discounted to the bank. It was dishonored by the acceptor. So, and the same had to be met by the firm. Now you know about bills receivable that you need not wait till the due date. So firm got a bills receivable from its debtors. It went to the bank, got it discounted and got the amount immediately. On the due date, the bank was supposed to collect it from the acceptor. Now, on the due date when the bank went to collect from the acceptor dishonored it. So now what will the bank do? It will take it away from the firm's bank account. So, and they said same had been met by the firm. Therefore, now 2,000 will be paid by the firm and it's a loss to the firm. So, and this bills receivable has already been discounted, will not be there. So, this loss we would debit to realization account 2,000 and we have to credit the bank account, cash or bank account. However, it is settled with the bank 2,000 rupees. This is for the bill discounted and dishonored met by the firm. Now moving to the next one. Last one we have is profit on realization amount to 6,000. After having passed all the entries, first step was transferring all the book value of the assets to debit side of realization account except cash and bank balance. And on the credit side, transferring all the outside liabilities and book balance. Then we pass the journal entries for the different transactions like debtors realized, creditors settled, and all that we have seen. Finally, the net result of this would be closing of realization account where we can have either a profit on realization or loss on realization. Now in this case they have given us that there was a profit on realization and it amounted to 6,000. Now when there is a profit on realization, it means the credit side total is more than the debit side. Therefore, you would be transferring off the profit by debiting realization account 6,000. This would be given away to the three partners. The three partners were Ravi, Shankar and Madhur. So we would credit their capital account. Ravi's account, Shankar's capital account and to Madhur's capital account in their profit sharing ratio. Now what was the profit sharing ratio? Here is the profit sharing ratio. In between them it was 7:2:1. So 7 by 10, 2 by 10, 1 by 10. So calculated all this base 10. So 6,000 divided by 10, 600. So 600 into 7, 4,200 to Ravi. 600 into 2, 1,200 to Shankar and 600 into 1, 600 to Madhur. So this is way how being profit on realization transferred to partners capital account in profit sharing ratio. If it was a loss, reverse entry would be passed. If instead of realization profit, it was a loss on realization, you would debit the partner's capital account, credit the realization account in the profit sharing ratio. Hope the concepts are clear and the journal entries are clear. Now here comes the self-assessment question of the day. Here I have given you a self-assessment question. Give the necessary journal entries for the following transaction: dissolution of the firm of Aman and Rajat on 31st March 2016 after transfer of various assets and third-party liabilities. Their profit sharing ratio is 2:1. We have given around 6 adjustments. Please do try this question. Don't take any outside help, don't use any other resource. Try to understand and pass the journal entries on the basis of the concept that you've learned through this video, and you will have the solution of this self-assessment question. I'll post it in the next video tomorrow. So that's it for today. Thank you. Have a great day.